Welcome back to Talk Tickers, where we give you the express lane summary of the market-moving intelligence coming out of the latest earnings calls.
And today, we are doing a deep dive into FedEx.
That's right. The second quarter fiscal 26 results, which just hit the wires after the close on December 18th.
And our mission today is, I think, pretty crucial because this is a classic market contradiction. You've got FedEx reporting a quarter of outstanding execution.
A massive earnings beat.
A huge beat. But at the same time, they outlined these substantial, really specific cost headwinds that are hitting them right now in the current quarter.
Which explains the stock reaction, or lack thereof.
Exactly. It was so muted. This is the market looking forward, and we need to understand what they see.
Okay, let's unpack this. I wanted to hit the headline numbers fast, but then get to the why.
Yeah.
So Q2 performance, it was legitimately strong.
Oh, no question.
Revenue came in at $23.469 billion. That's a healthy 7% jump year over year.
And it easily surpassed the street's consensus, I think by over $600 million?
Yeah, $670 million. But the bottom line, that was the real shock wave, right?
Adjusted EPS, the non-GAAP number, hit $4.82.
And the consensus was sitting way down at $4.
So that's a 71-cent beat, a 17.3% outperformance. That is just crushing it.
And that profitability came from adjusted operating income climbing 17%, which led to 60 basis points of margin expansion. I mean, the numbers just on their own look phenomenal.
Phenomenal.
But here's the puzzle. You crush EPS by nearly 20%, you raise your full-year outlook, and the stock, it barely moves, up less than 1% in after hours. So why? Why did the market just shrug?
It signals a really critical dynamic. Investors right now are just instantly skipping the rearview mirror. That great Q2 is already in the past.
Already history?
It's all about the forward-looking guidance, and specifically the guidance for the current third quarter. The market's caution is based on how tough it is to operate right now.
Not yesterday.
Exactly. The performance was impressive, but the price tag for maintaining that performance is what caught everyone's attention.
Okay, before we get to those costs, we have to talk about how they drove that Q2 beat. Because it wasn't just, a return to pandemic-level shipping volumes.
No, not at all. This was structural. It was yield-driven.
Right.
If you look at the Federal Express Corporation, FEC.
That's their express segment, right? The planes, the international stuff.
Exactly. The time-definite air and international freight, its revenue grew 8% year over year. And that's crucial because FEC delivered 100 basis points of adjusted operating margin expansion.
Wow.
And get this, that's the 5th consecutive quarter of year-over-year margin improvement in that business. This isn't a fluke. It's the transformation paying off.
And the key to that revenue growth wasn't just a surge in boxes.
Not at all.
U.S. domestic package yield, the money they make per package, was up over 5%. Even while the actual volume of packages only grew 6%.
That shows real pricing power, real discipline. They are optimizing their revenue mix.
Which leads right to their B2B focus.
Absolutely. Management was explicit. They said nearly half of their total Q2 revenue growth came from business-to-business services.
And B2B is just better for the bottom line, right? Higher yield, less hassle than dropping a single package at someone's front door.
Inherently higher yield and, yes, lower touch operationally.
They gave some great examples, too, like winning more B2B business from BMW.
And I thought this was interesting. They formed a whole new dedicated data center and infrastructure team.
What's the mission there?
To go after high-value, high-tech capital expenditure spend. That's really sticky revenue. It's not just random packages. It's critical infrastructure.
And this all ties back to their big self-help plan, Network 2.0.
Exactly. That's what's underpinning all of this execution. And they're making real, tangible progress. They said 24% of their eligible daily volume is now flowing through 355 optimized facilities.
And they've closed over 150 facilities overall?
They have.
Now, wait a minute. Closing 150 facilities sounds great for an earnings call slide, but what does that practically mean on the ground?
It means they're shrinking their physical footprint to increase density, to reduce the miles a package has to travel.
So, fewer stops.
Think of it this way. Instead of a package going from a small local sorting facility to a regional hub and then to another distribution center, they're just cutting out steps.
Fewer redundant handoffs.
Which cuts redundant labor, reduces fuel, simplifies maintenance. That consolidation is the engine driving the margin expansion we saw in Q2.
They're also looking beyond just the physical assets, though. They talked a lot about tech.
They did, launching a global AI program for all 500,000 plus employees. But what I found really fascinating was the collaboration with ServiceNow,
Why that?
because it's external market validation. FedEx is monetizing its own proprietary logistics intelligence.
You mean all the data they've collected over the decades?
Decades of data on package flow, customs, network friction. By partnering with a huge enterprise software company like ServiceNow, they're turning that internal data into an external product. It proves their operational brain has value outside of just moving boxes.
That structural change is powerful. But you're right, the market is focused on costs. Let's pivot to the noise that hit the stock. We have to talk about Q3, starting with the big one, the MD-11 grounding.
This was a genuine shock, a real curveball.
So what happened?
Following a safety review, which was prompted by a recent incident, management grounded 25 of their 34 owned MD-11 aircraft.
25 out of 34, that's a huge portion of that fleet.
It's a significant chunk of their 3-engine cargo fleet. It represents about 4% of their entire global capacity, and it happened right during peak season.
December and January, the two busiest months of the year. What a logistical nightmare.
It was a massive operational scramble. The grounding hit Q2 operating income for about $25 million, but the real pain, the bulk of it, is hitting Q3 right now.
And they had to find a solution, fast.
Swift and expensive contingency actions. Since 18 of those grounded routes were U.S. domestic, they shifted a lot of that volume to trucking. But for the heavy international site...
What the MD-11 was built for.
Exactly. For that, they had to secure a third-party lift, chartering planes from other carriers at historically expensive peak season rates.
Ouch. And what's the total damage from that scramble?
Management put a number on it, up to $175 million in total peak season costs.
Wow.
And the vast majority of that is hitting this current quarter, Q3. It's a perfect example of prioritizing service over short-term costs. They're willing to eat the expense to keep their promises to customers.
Okay, so that's $175 million in immediate temporary noise. But you said that's only one piece of a roughly $600 million headwind.
That's right, a $600 million year-over-year headwind embedded in their second-half outlook.
Which raises the question, right? If Network 2.0 is saving all this money, why is $600 million in new costs piling up? Doesn't that just wipe out the savings for now?
That is precisely the challenge for investors. So this $600 million is built out of 3 main buckets. We have the $175 from the MD-11s.
Got it.
The second component is about $160 million, and that's due to continued softness in their LTL business.
LTL, that's Less-Than-Truckload. For listeners who might not be in logistics, that's for smaller shipments that don't need a whole semi-trailer.
Correct. And it's highly dependent on industrial production, manufacturing activity.
Which has been soft.
Very soft. So their average daily shipments in the freight segment are down. It's an external macroeconomic headwind, and it's hitting them right before they plan to spin that business off.
Okay, so $175 for the planes, $160 for LTL softness. That leaves about $265 million unaccounted for. What's the biggest piece of the puzzle?
That is the highest performance-related piece, the higher accruals for variable incentive compensation, or AIC.
AIC.
This $265 million is what we're calling the AIC catch-up.
Okay, performance pay, I get it. But $265 million is a massive number to swing the comparison. Does that mean they were just drastically under forecasting last year? Or is this really a normalization cost, like they say?
It's defined as a normalization cost. See, last year, in fiscal 25, their performance was pretty depressed.
So bonuses were low.
Very low AIC payouts. Now, because of the strong execution this year, the margin expansion, the B2B focus, they are legally obligated to accrue for much higher performance-based pay.
So compared to last year's really low number, this year's normal number looks like a massive new expense.
It acts as a massive financial headwind. It's actually good news. It means they're hitting their targets, but it's disruptive to that year-over-year comparison.
So you add it all up, the MD-11s, the LTL weakness, the AIC catch-up. That's your $600 million in noise that's forcing Q3 EPS to be sequentially lower than Q2.
And here is the core message, I think. Despite absorbing that entire $600 million of specific, temporary, and normalizing costs, management still felt confident enough to raise the full-year adjusted EPS range.
To $17 to $19 raise.
Right. And that confidence suggests that the transformation savings and the yield actions are powerful enough to not just absorb those costs, but to still lift the bottom line for the full year.
That really does make the underlying story compelling. Let's shift to the long-term structural change that's supposed to unlock value no matter what, the freight spinoff.
The separation is still the key catalyst. The spin-off of FedEx Freight is completely on track for June 1st, 2026.
With the proposed ticker FDXF.
FDXF. And they confirmed a huge milestone. The confidential Form 10 was filed.
Okay, what did that mean?
It means we're going to get our first real look at the standalone financials and the forward strategy of this new company, probably in January.
And they're building up the anticipation with an investor day in April in New York.
Absolutely. They want to get the story right ahead of the separation.
But, as we just discussed, that freight segment is under pressure right now.
It is. Revenue is down 2% because LTL shipments were down 4%. And on top of that, you have separation expenses.
Things like building new IT systems, hiring a whole separate sales force.
Exactly. And that's pressuring the segment by about $100 million.
So here's the dilemma, right? Is FedEx spinning off its least healthy business at a moment of cyclical weakness, which could depress the new company's initial value?
Or is this separation happening at the bottom of the cycle, setting up the new company, FDXF, for a quick rebound? That's the billion-dollar question.
But the strategic goal is clear.
It's about removing the conglomerate discount. By separating the air and ground package business from the heavy haul LTL business, the market can value each one against its pure-play peers, and hopefully unlock hidden value.
And what about their capital plan while all this is going on?
Still committed to shareholder returns, they bought back nearly $300 million in stock in Q2.
And they're still spending big.
They reaffirmed a substantial $4.5 billion CapEx plan for the year, and that's focused heavily on Network 2.0, new aircraft modernization. This transformation is not cheap.
Okay, so we have a clear picture. Strong underlying momentum and structural gains, but they're being severely offset by these temporary high-impact headwinds in Q3.
That's the setup.
Which means it's time for the part of the show where we talk about translating this knowledge into a focused strategy. This is not financial advice segment.
And the setup here is, I think, perfect for a speculative leverage bet.
Okay.
The Q2 results prove the transformation is working. Express margins are up, B2B is succeeding. The stock is currently held down because of temporary friction. The 175 from the MD-11 grounding, the 265 from the AIC catch-up.
These costs are finite. They're not structural.
Exactly. So if the long-term story is intact and the price is depressed by short-term noise, you want an instrument that can capture a potentially large move tied to a long-term event.
You're talking options.
Precisely. The pitch is to initiate a leveraged long position using deep out-of-the-money call options on FedEx stock expiring in late June 2026 or later.
Okay, let's break that down. Why options and what does out-of-the-money mean?
Call options give you leverage. You can control a lot of shares for a small upfront cost. It magnifies your potential returns. Out of the money means the strike price is significantly higher than the current stock price.
So it's an aggressive bet. You need a big, sharp move in the stock for it to pay off.
A very big move. But if it hits, the returns can be massive.
And the timeline, late June 2026, that's not random. You're targeting the convergence of two huge catalysts.
That's the key. This trade is designed to capture the upside from both events. First, the successful freight spinoff on June 1st, 2026. That removes the conglomerate discount and gives clarity on the value of the remaining part of the company, what's called the stub valuation.
And
Second, this expiration date gives the market time to look past all this Q3 drama. By then, the MD-11 issue will be resolved, the AIC headwind will be gone from the year-over-year comparison, and the underlying improved margin profile of the express business can finally shine through.
So it's a calculated wager. You're betting that the long-term self-help transformation narrative wins the war against this current temporary operational friction.
That's it. Ultimately, the core takeaway is that FedEx is delivering strong underlying momentum. It's led by disciplined yield management and a smart B2B focus. But you, the investor, have to navigate this profoundly noisy third quarter.
Keep your eyes on the structural improvements, not just the quarterly noise.
Exactly.
There's a lot to monitor over the next 6 months. And on a historical note, which I thought was interesting, management acknowledged that the Memphis airport is being renamed.
Right, in honor of their founder, Frederick W. Smith.
The company that basically invented time-definite shipping now operates out of the Frederick W. Smith International Airport.
It's a powerful acknowledgement of a monumental legacy.
It really is. And it makes you wonder, what does it mean for a company to pivot so structurally? From a decades-long legacy model that literally built an entire airport complex to this new digitally integrated post-spin future focused on AI and yield.
It's a huge shift.
Is that $4.5 billion CapEx plan supporting a legacy vision? Or is it truly building the infrastructure for a completely new, more focused empire? And that's the question we'll leave with you as you continue your research.
Indeed. We'll catch you next time for the next deep dive.